Thank you, everybody, for joining us today. My name is Christos Stefanov. I'm with Cetera Investment Management, and I'm going to be the moderator for today's call. Or today's meeting, I should say, call. I've been on too many calls this morning, so that's what still brings me to the same session. But today we have a great panel for you. This session is focused on allocating to alternatives from a strategic perspective, and we have a lot of both quantitative research background on this panel, as well as actual implementation background into alternatives. So with this, I would like to let you know who we have. I'm joined by Karen Williams, who is the Regional Chief Investment Officer for Zurich Investment Management. Karen also founded a startup and actually a consulting firm called High Tree Analytics, which is focusing on research on alternatives as well. And that is a substantial portion of what we're going to cover on part of the discussion today. We also have Anthony Polemis, who is with iCapital. iCapital has developed a lot of tools for actually practical implementation of alternatives and research of alternatives as well. So we're going to cover the architect platform that Anthony leads for iCapital. And finally, we have Brian Resnick, who is the actually strategist and leader of the investment strategies for alternatives at AllianceBernstein. And Brian has a lot of practical implementation. And also, I do want to say he studied financial engineering at school. So that's actually a special thing that could help us bring alternatives into traditional portfolios here as well. Brian is also, maybe a small item, he's also a magician, so if we have time at the very end, maybe
if anyone needs any entertainment later on, I'm available from about 9 till 11.
Thank you again for the time. So what we want to cover today is a couple of things. First, we want to speak about some analytical support and analytical tools, how to think about alternatives on a broad basis. The second thing we'd like to cover is how do we actually take a look at alternatives and implement them into a traditional portfolio. From there, we would like to bring it a little bit closer to a selection of managers. How do each one of us think about selecting managers? What are the types of managers we seek? What are the types of strategies we seek? And finally, we can speak a little bit about exactly how practically we have implemented those in portfolios. So those are the 4 items that we would like to cover. And maybe we can start with Karen. I think, Karen, you've done a lot of work with Zurich as well as Venn by Two Sigma. You've done a lot of work in evaluating alternatives. How do you normally model alternatives, and how do you think about them as compared to traditional investments that have a lot of traditional history?
Thank you. I'm happy to talk about this subject, and it's very near and dear to my heart. It's something that I've practiced probably my whole career in thinking about how do we model securities generally for practical purposes in investment portfolios and portfolio construction. And when I say portfolio construction, who do I mean? It's not the portfolio manager who necessarily would trade a portfolio day in, day out, but really, and rather for me, it's the allocator. And I started this journey when, as an academic, and I'm teaching modern portfolio theory, and I'm thinking about, well, gosh, how do we do mean variance optimization? And I, made the leap from the academic world to the practical world, and I said, wow, this is crazy. It's over-constrained, and all these asset classes don't really fit. And how should we come at this in a way that's super practical and could be super useful? And so I took a look at a factor framework, which we had in my team built at Wilshire Associates many years ago, and said, maybe we could just boil this down, this approach of describing securities by their factor exposures in an analytical way with a set that would be robust and describe most of the variation in securities through time, that would be understandable by even an investment committee or even potentially a board. What is that factor? What does it do? Can I explain it? And then useful in the sense that it's a framework to pull everything together in the investment portfolio, not just the analytics. Not just the alts, not the analytics, just the alts. Because, of course, it all fits together in the same portfolio. And so over time, I thought, all right, well, let's focus on a set of factors that could be really strong to those requirements that I set, those specifications. And so that's the way that I approach allocation. That's the way that I do it in practice. I did it at Farmers. I helped when I went from Farmers to Sigma to build a technology called Venn, which is like a factor analyzer, taking, both at Farmers, which is related to Zurich, but also to Sigma, that basically just requires returns of investments, either securities or funds or whatever, however you want to describe it, and from there determine what are the exposures to those funds or securities to the factors. So the set was very simple, it comprised 7 factors, and robust to the estimates of exposure. Think growth, inflation, duration or interest rate risk, commodity, term, illiquidity. So a handful of factors being able to describe every security in the portfolio. So effectively a framework that captures everything and simple. So anyway, that's a framework that I have long applied and developed and use today. And we'll talk a little bit more about how I use that, but I have found that gives me as an allocator and others who don't have the ability to buy certain systems that cost $1 million or $2 million a year and at security level. And most people don't really need that. Most people just really need, what am I exposed to collectively in the portfolio to equities? What am I collectively exposed to in terms of interest rates? And those pieces being the ingredients is how things can be aggregated. So I'll just pause there because I said a lot, but that's how I come at that.
Thanks, Karen. So breaking it down to factors tends to work, and also breaking the portfolios to the separate exposures. Maybe we can bring it to Brian as well. Brian, how have you done this at AllianceBernstein?
Yeah, sure. So, in a similar way, we're utilizing underlying economic variables. And when we model portfolios, we really start with our modeling of the economic variables in a Monte Carlo, effectively allowing those variables based on current conditions to run 10,000 Monte Carlo simulations over a time frame, and ultimately we model every asset class to that. So you can think of most asset classes as having building blocks, and in a very similar way, ultimately pairing back to the underlying economic environment. So whether it's public equities and you are modeling out return on equity and valuations and dividend yield on top of those economic variables and allowing that simulation to run, you can do something similar with private markets. If you think about private credit, you can really model it largely as a spread above LIBOR with a loss rate. And of course, that's going to be dependent largely on how accurately you're going to model that spread behavior, but then of course how it's impacted by the economic environment. So ultimately we start with, again, modeling the underlying economic environment, the building blocks for most asset classes, and then building that up to ultimately look at how a portfolio in its entirety would likely perform over the long run. I will say one of the things that comes up a lot with modeling alts and private alts in particular is that, regardless of how you model it or how you think about it or how you simulate it, you're typically going to have, a premium in terms of return and lower volatility. And from a quant perspective, normally when you model, you want to think of things in terms of a no arbitrage, right? That's kind of a classic quantitative way to model things, meaning there's no free lunch. And so if you're getting lower volatility and higher premium, then you must be picking up risk somewhere else. And so quantitatively, we like to put that in the tail risk in terms of, what can go wrong in the extremes. And so we add in tail risk into all of our private markets to compensate for the fact that, again, there is no free lunch. And I think it's actually, there's evidence to suggest that it's true, because you do have less liquidity, you have more opacity, and ultimately more can go wrong and you can be stuck in that investment. And so because of the complexity risk and the illiquidity, you do see tail events. And I think that's most evident in the dispersion amongst managers. And I know we're going to talk about that in a little bit, but ultimately you see managers in private credit, for instance, have a differential of about 1,000 basis points between the top and bottom performing managers. It's practically a different asset class. And when all of us are modeling asset classes, we're modeling the average. What on average should you expect to get? What on average should you expect from your volatility? But there's a massive range, and I think that dispersion amongst managers is evidence of the tail risk that's naturally embedded in some of these less liquid markets.
And maybe a little bit of a follow-up to this question. In your view, maybe Karen and maybe Brian, do you feel that that dispersion of managers is something that prohibits people from taking a look at an asset class as one single asset class? As you mentioned, there may be some dispersion between managers, but can we still think about alternatives as somewhat of a generic asset class that you have exposure to private credit, to infrastructure, to something like this? I don't know if you may take a look at that, and what are some ways to even simplify the allocation when you take a look at alternatives that way?
I think that's always the challenge, is we want to homogenize, kind of categories, because that's how human beings think. We think in terms of annual performance. Why should Jan 1 to Jan 1 matter, right? But at the end of the day, it does help us to make decisions. And so I think there's always a trade-off between the fact that, these different categories are not a monolith. Even equities are not a monolith, right? You have your equity exposure, but small caps in emerging markets look very different than large caps in the US. And so I think in general investing, there's always that trade-off between thinking about things as a monolith versus recognizing that there's many different ways to do it. And again, I do think that with alts in particular, because there is such a dispersion of outcomes, it's probably a better starting point if you're newer to alts to think about the outcome that you want and making sure you select managers and strategies that can deliver that, as opposed to trying to check every box.
And I think people don't know. It's not something you can just guess at. And, I think this will deliver. I think this alternative structure or this combination of alternatives is going to deliver in a particular way, or have a particular risk, or interact with the rest of the portfolio in a very specific way. And in fact, it's putting it through a quantitative process and asking the question, what are the exposures to this particular manager or this collection of managers, is incredibly revealing. Sometimes you'll find out, relative to the benchmark, they outperformed over a long period of time, but, hold on, that's not because they invested the way that I expected. That's important information. And I feel like if you don't have a quantitative approach like this to alternatives, you just lump them into a class, you say, well, that's my alt class, you really do miss risks that you would otherwise be able to identify very quickly and practically. And so that's why I like the approach. But anyway.
Thank you. So I do get a couple of things here. First of all, not all alternatives are made equal, so you have to have quantitative approach and a fairly deep quantitative approach. The second thing is you have to be aware of tail risks, and maybe I can bring this to Anthony a little bit. Anthony, you with iCapital, your firm has done a lot of work in preparing tools and portfolio analytics tools that you offer to advisors. How does your team think about educating advisors and educating the public about alternatives, and how do you? What are the tools that you have to actually help us with that?
Yeah, absolutely. So, I think what we're seeing obviously is a mega trend in the industry, right? Private markets are becoming more and more table stakes for financial advisors. And so alongside that, advisors really need tools to help them sort of understand the role that they can play in portfolios, and also really explain those things to clients. So I'll pick up on a couple of the threads that my co-panelists here have started on. So number one, at iCapital, we deliver access for financial advisors to alternatives. We have hundreds of funds on our platform from top tier managers across sort of the spectrum of alternative assets. But really, alongside that, we deliver subscription processing, which is obviously very important as you think about alternatives. But then we also focus, and this is where I'll kind of focus my comments here, on educating advisors, number one, on the asset classes, broadly speaking. As you're kind of wading into this asset class, you need to understand, at a fundamental level, what is private equity, what's private credit, how do we think about illiquidity, how do I explain that to a client? What we also do, though, Brian, I think you mentioned dispersion among individual managers. It is so important to understand the nuances and distinctions between different funds, just because those interquartile spreads are so large. But beyond just being educated about funds and alts broadly speaking, what we have heard from advisors historically is, advisors are used to using portfolio construction tools. Institutions are used to using them. I worked at BlackRock for a very long time in the Aladdin business, and I've seen sort of the power that factor models can bring to institutional analytics. Advisors, though, historically haven't had that. These tools can be extremely expensive. And so what we did is we heard our advisor feedback, and we developed actually a portfolio construction tool that is designed to help advisors evaluate alts within the context of portfolios. Now, to do that, we've mentioned a lot of the challenges here, right? Number one, alts are illiquid. Oftentimes, they were going to report the returns quarterly and on a lag. What does that lead to? It leads to sort of artificially smooth volatility. We've mentioned a couple times here on the panel today, if you just look at, if you say, hey, I'm just going to put, a private equity bucket in and show you what that looks like, well, that's going to paper over, a pretty big interquartile spread. So, you really do need to analyze funds at an individual fund level. Well, how do you do that? And then how do you kind of grapple with this kind of, our smooth volatility concept? Or, oftentimes you might have funds that have really short track records, right? The evergreen space is getting really popular. Well, the evergreen funds that have the longest track record in the market often, only have, a couple of years, sort of at best. So how do you kind of wrap your head around all that? Well, what we did is we built a pretty large quant team at iCapital. We applied a Bayesian statistical approach to factor modeling. Effectively what we do, Karen, probably, there's some similarities here in terms of our approach here. But what we try to do is we try to take a fund's track record, we'll regress that against a set of factors. We try to figure out, what are the underlying, drivers of risk and return. We use that to actually de-smooth the sort of the artificially smooth volatility. So we try to give users a more apples to apples comparison between their publics and privates. And then what we also do, which I think is innovative, is we will actually estimate historically what might the returns have been. We'll use a few different techniques for that, but that allows us to do some of this kind of historical stress testing that you mentioned, which I think can be useful. Putting that sort of all in a blender, what's this sort of unlock for advisors? Well, as you've got advisors who are coming into the asset class, might be newer to it, we're getting them educated, we're getting them sort of up and running, but ultimately what we're trying to do is build confidence. As private markets become table stakes, we want advisors to have more confidence. We want them to have better conversations with their clients. That's what we're trying to deliver.
Thank you. And in full disclosure, actually, Cetera is a client of iCapital. We have gone through the same tool a couple of times. Actually, this week we're going through it with a portfolio we're building. So it's been for us particularly at Cetera, has been a really helpful tool, and it helps us integrate alternatives with traditional portfolios, and that's worked actually quite well. We have a couple of portfolios that we've looked at that are evergreen, that don't have the track record, and iCapital's tool has been helpful in building at least a 5-year track record, so you can take a look at how the portfolio may look historically. So I don't know, that may be a shameless plug a little bit from my perspective is what we're doing at Cetera, but maybe I can turn over to Brian for a second. And Brian, how do you think about incorporating alternatives into a traditional portfolio? Do you have any constraints? What are the things you think about when you do that?
Yeah, so listen, at AllianceBernstein, we're always starting with the quantitative models we spoke about. So sort of simulating the portfolio, stress testing it across those different simulations to get a sense of what might be optimal. Obviously, there's a qualitative element to it as well, but I think from a practical perspective, really how alts are being implemented is changing quite a bit. It used to be that, alternatives were, and you talk about some of the constraints, were practically seen as a separate allocation. So you had your liquid allocation and your illiquid or alternative allocation. And the practical reason around that is you just weren't able to rebalance with the same level of frequency. So if you think about an investment policy and the need to rebalance, once you begin to break that, it can be problematic. And so again, what we've seen a lot of large institutions and ultra high net worth individuals do is ultimately hold that separate as if you have an alts allocation that is complementing your traditional allocation. But I think now as we see these evergreen vehicles that are emerging, whether it's in private equity or private debt or real assets, one of the great things about that, and there are positives and negatives, but one of the really wonderful things about that is that you now can rebalance with more frequency, and in many cases on a quarterly basis. And what this opens up the allocator to be able to do is not think of alts as something separate, but think about the alternatives that can begin to enhance each piece of their portfolio. So private equity as an enhancement of the overall equity sleeve, private credit as an enhancement or an integration in the credit sleeve, private real assets alongside your public real assets. And so we're getting to a point in which you can begin to allocate, because of the vehicles that are out there, because of the evergreen nature of these vehicles, really one portfolio. So in the way that we might model it as one portfolio, in reality, in drawdown funds, it doesn't functionally work that way. So I think things are really changing, and I think the better approach is to model it as one integrated portfolio. Again, if you're using drawdown funds, there are some challenges. If you're just building an allocation or building a program, it could take years to build up. Obviously, the cash flows have to be managed. But to the extent that you can use evergreen, we think it's a really practical solution to just implementing like you would any of your other investments.
Thank you. And maybe a question to Karen. Do you have any preference between drawdown solutions or maybe evergreen solutions at your practice?
So that's just it's not exactly a fit. We have 2,400 private equity companies in our investment portfolio, and we never have to touch it. So we're happy when liquidity returns and we just keep investing. And I'm very excited about that. But I do think that there is a role for those funds in certain portfolios. But I'd like to pick up on the point that you made. I think it's imperative to look at the whole portfolio today because the market is changing. So there are half as many public companies today as there were in, I think, in the 90s. So half as many public equity companies. And for companies over $100 million, 80% of them are private, and they need to be funded. I guess I would say the last sort of piece for me in this puzzle of the market, microstructure has changed and we need to look at the portfolio differently is that only 19% of banks' balance sheets is dedicated to loans. And so, the whole market has opened up to the CFOs of the world, to the finance directors of the world. And when they come to the market to borrow money, they might go to the public market, they might go to the private market, they're going to look for a solution. So we're going to see a name potentially or combinations of exposures through structured in different parts of the portfolio, which advocates and especially advocates for getting a handle on, well, what kinds of collective credit risk do I really have in the portfolio? So, I just want to underscore that I think having a total portfolio approach is super important. One thing I would like to add is that a second reason why I created the framework that, for high tree analytics as a factor framework is I felt like there was very little good information about risk. That most people sitting on an investment committee, sitting in a board, if you talked about a standard deviation or value at risk or, CVAR, expected shortfall, shall I go on? They have no idea what you're talking about, even if you repeat it every quarter. So that's sort of problem number one. Problem number two is if you introduce something like a buffer fund, a buffer ETF, or you introduced, a different kind of exposure, levered exposure through an ETF, and I think, by the way, the ETFs comprise the future of investment management, that it would be very difficult to understand what the impact of your outcomes would be. So why not put together a Monte Carlo-based approach where you can ask the question, hey, if I add this alternative manager to my portfolio, do my outcomes and the potential for success that I want improve or not? And if they do improve, what is that worth to me today? Because it could be an improvement in risk solely. Think of a tail hedge fund, for example. And there are lots of examples, a lot of really great tail hedge organizations out there, which basically mean your portfolio draws down to a certain level and you're going to get paid. And you're going to get paid at the time when you can put money back to work in the market when no one else can. So you're providing liquidity to the market. Can that add value? Can that improve your outcomes? Net of the fees that you would pay along the way to support it. So anyway, it's possible to do that in a framework that's simple, that looks at, takes a Monte Carlo look at the future and says, for this outcome and for this outcome, I have a certain chance of success. What is that actually in dollars today worth to me? Most people can get their head around that. And anyway, I think increasingly, we operate in a world in which that is an imperative to have really strong portfolio construction.
Yeah, and if this brings us back to strong portfolio constructions and the tools that are actually supporting that, maybe I can bring this back to Anthony about some of the tools that iCapital has developed for portfolio construction. How do you model some of these strategies, the drawdown strategies, evergreen strategies, and so forth? If you can bring us to that.
Yeah, certainly. So, I think the drawdown evergreen dichotomy is really interesting. And, obviously the evergreen funds have been, I think, a phenomenal innovation for the industry. From an advisor's perspective, the end client's perspective, there's number one, just a big convenience factor, right? You can be fully invested on day one. Oftentimes you don't receive a K1, they're 1099, relatively easy to get, invested. And so, from our perspective, I'm glad that everyone on the panel, no one said the word semi-liquid yet. For us, it's very important. These are ultimately illiquid assets and should be treated as such. In our opinion, yes, there's the opportunity for liquidity, but really investors should think about these things as, you're in it for the long term, because odds are, if you really need to get out, there's a big market event, you may not be able to. So, you should think about it, in that way. But that being said, I think the evergreen structure is really popular. We're seeing a tremendous amount of growth, in that structure on the platform. That being said, though, for QP type investors, drawdowns have been extremely popular. I think just from a modeling perspective, from an evergreen standpoint, there's a certain certainly there's an element of ease, right? There's really, as a result of there being no J curve, you do kind of get a relatively cleaner time series of returns. Oftentimes these products will report, the returns on a monthly basis. So, you get something that you really work with from a factor modeling perspective. Spent a lot of time talking about evergreens, but in the drawdown space, that's much more difficult. You've got that. Quarterly reporting, the reporting on a lag, and as a result of that, that's when really kind of we take the Bayesian statistical approach, into account, and that's what lets us, really, do some of our magic in terms of making things a bit more interpretable. But, it's an exciting time, seeing the proliferation of these strategies and the ability for more and more people to have access to private markets.
Thanks, Anthony. And then maybe to Brian, I think there's been some criticism sometimes of those evergreen structures that obviously they hold a little bit more cash. And maybe give us your views on that.
I think that's a great question. I actually think it's kind of the opposite. So if we think about the dispersion between the returns on average of the evergreen structures versus the privates, it's probably much smaller in reality. I think MSCI just put out a great paper on this exact topic. And the idea is this. I mean, if you go into an evergreen, you're fully invested on day one. When you look at returns, or even, sometimes you see now they have some really rather great indexes. Preqin's got some great indexes on private markets in particular. Those indexes are IRRs. They're not total return on invested or committed capital. And if you actually begin to take into consideration the cash drag, or what you're doing with all of that committed capital that's not drawn down, even if, let's say, you're in private credit and you invest that in public credit, what you find is that the returns are not that different than a BDC or an interval fund that's fully invested. So I actually think that in some ways you're getting more for your money in these evergreen strategies, because not only do you have a full portfolio on day one and you avoid the J curve, but also they're managing that liquidity for you. They're managing what they're doing in the liquidity bucket. They know when they're going to call capital for a new deal. And in so many ways, I really believe that, and we saw this on a panel earlier where someone was mentioning that, interval funds and some of these evergreens are probably going to become more and more utilized in the institutional space, because there's a tremendous amount of value add there, especially when you consider that the fees are lower. So in many ways, evergreen, we think, is an evolution. It's not a watering down. If anything, it's an improvement. And listen, I understand the skepticism. When we saw alts, liquid alts 1.0, where the idea was to take hedge fund strategies and bring them to mutual funds, it didn't work because it often was watered down. Maybe you got not the best trades, but the second best trades, or maybe it was, watered down in terms of the quality of manager. But this is, I think, a really interesting time in which accessibility to the best investments are there for almost everybody. It's a very unique time in our business, and I think it is different this time.
Thank you, Brian. And then maybe I can bring a little bit of perspective from Cetera's side. From our side, we only use evergreen structures right now. We don't use any drawdown structures because we deal with mostly a mass affluent type client. And for us, that's been a very key step in democratization of alternatives. If we're actually using a drawdown structure, we will be a lot more constrained as to how many clients we can offer it to and to the amounts of trades that we can put in. So that evergreen structure has allowed us to build portfolios for much lower allocations, at least in our practice. One thing I wanted to ask, and maybe to any one of the three of you, about diversification. How do you think about diversification with all these alternatives? Obviously, if you can find a really good manager, you want to put all the money in that particular one basket. But at what point do you diversify your private credit or maybe private equity to 2 or 3, or how many is too many?
Well, I think, as I said before, manager diversification is somewhat important because this is a very idiosyncratic market. Alts in general, whether you're talking about hedge funds or private markets, are ultimately about reducing the overall market beta and increasing your idiosyncratic types of return. Whether you call it a premium or alpha or liquidity, whatever you want to call it, ultimately you're looking for less return from the market and more from something idiosyncratic. And so by nature, you're going to want to have some diversification across that idiosyncratic, all those different idiosyncratic sources of returns. But having said that, it's not always practical to have multiple managers. And so, you asked about private credit in particular. And again, in a panel earlier, they were talking about asset-based finance, which is, fantastic growth area within private credit. And so a great starting point is to have managers that manage in each one of those different pools. That'll ensure that you have diversity from an idiosyncratic perspective because you're getting alpha from different areas. But even within those, if you're able to put a platform together where you can hire lots of high quality managers, your probability of hitting those averages that all of our quant models expect is going to go up. So I do think diversification is important across different categories and across different managers, but there's also a practical element to that as well.
Yeah, I think I can take a stab at it here. I think there's a few different ways that we think about it. Number one, from diversification broadly speaking, I think alts can be phenomenal diversifiers. We talked a bit about tail risk hedge funds, for example, but certainly there are many hedge funds in our platform that have performed well, during down markets. You add them to a portfolio, you see better Sharpe and Sortino ratio, for example. Part of what our tools help advisors do is kind of think through, hey, if diversification is one of my goals, well, how do I, find the right funds that help me reach that? So that's just broadly speaking from a portfolio construction perspective. I think there are a lot of alts that can sort of bring diversity to a to a public market portfolio, let's say. The other thing that I'll mention though is as you're thinking about you mentioned manager diversification, obviously also very important. But as you're thinking about that, and as you're thinking about, let's say, diversifying into 2 or 3 private credit managers, you want to think about what are the actual underlying portfolio companies that I'm ultimately lending to. You might have 2 or 3 managers who are lending to the exact same type of company. So I think as you think about kind of constructing a portfolio for multi-managers, you want to think about let's say with private credit, am I going to the upper middle and lower middle market, for example, as a strategic way to allocate sort of fully to that asset class.
Thank you. Appreciate that. So there's definitely different ways. Looks like manager diversification is important. Also, the type of market is important as to where you would like to allocate. I'm going to bring one practical perspective from my own experience. The one thing that we are actually seeing, we use, as I mentioned earlier, mostly evergreen managers, but they are subscription document type managers. And we are seeing that there's a limit to the diversification we can actually accomplish for our clients. In about 6 to 7 strategies in a portfolio, an alternative portfolio, is where we're actually hitting the maximum because, quite honestly, even though we automated it with iCapital's help quite a bit, it still is about 200 pages of paperwork and a number of signatures. So when it gets to that level, and we have 6 or 7 strategies, that's where we're actually starting to hit the maximum. So that's about 10 to 15% allocation per manager. Some of the really thinly traded managers, even though we would like to allocate to, from a purely operational perspective, we have stayed away from.
I would just add that I'm kind of with you on a limit in terms of number and effectiveness, but we come at this question more top down and then bottom up. Meaning we're going to ask the question, if we need to hit some hurdle return, what are we willing to trade off to get there? And of course, you can answer that question by looking at a set of managers that some may be under consideration. Do they fit and do they advance that probability of success? And so I'm going to be looking at a set of managers, say in hedge funds or say in private credit, that have gone through, for us at least, an initial assessment of what is their organization, a proper due diligence, a sort of an initial screen. But then it's a question about fit. And some managers simply have better overall fit with our portfolio given their exposures to credit, to illiquidity, to interest rates, to term. And so that informs the combination of managers that we would pick. So no, to our earlier point, each of the managers is going to express what they do through a different investment process, and they're going to have different exposures, and they're going to have different performance. So this is why I like to take a quantitative look at a manager and how they would fit into a portfolio from a factor perspective, because that is the risk that they all share.
Thank you, Karen. So a little bit more of a top-down view and maybe a little bit more concentrated manager view from Zurich and the team. One thing I wanted to bring up, and maybe this is going to be a couple of the closing comments as far as where we are allocating to right now. Maybe I can start with that end of the panel from Brian, work to Anthony and to Karen. But what are the types of alternatives you allocate to?
In other words, top high conviction ideas?
Yeah, I mean, the things that you mentioned, asset-backed finance earlier, what are the things that are coming up?
We do everything from quantitative hedge funds, qualitative hedge funds, asset-based finance. I mean, we're an asset manager, but we also have a private client, and we really do everything across the board. And then within the private client, we're doing, private equity as well. So there's really no area of alts that we don't particularly touch. I will say the area that we're very excited about today is the burgeoning area of asset-based finance. I mean, it is just, let's face it, if we're talking about an idiosyncratic type returns, if you're talking about finding alpha, finding something unique, the less efficient a market is, the better off you are, especially if you have expertise. And so that's an area that we've been really excited. We've invested a tremendous amount in terms of acquiring talent, really we acquired an entire firm, Carval, to be our arm of asset-based finance. And we're in the market with private funds as well as interval funds and multiple access points. But again, without getting into too much detail on the space, asset-based finance for us is it's exciting because if you think about the disintermediation of banks that we've heard a million times in terms of them stepping away and private credit stepping in about a decade and a half ago as it relates to traditional direct lending, we've seen a slower burn on the asset-based finance side, but we're really seeing an acceleration there in terms of the demand in the global economy being more than banks can ultimately supply. And what's exciting about asset-based finance is these are incredibly complex deals. They're much more difficult to underwrite than a typical corporate deal. And so the specialty you need to underwrite it is rather large. And so that difference in dynamic between demand for capital and supply is one that, again, has really made private markets exciting for the last decade and a half. And we think that is the next wave. So that's the area we'd be leaning into most today.
Thank you, Brian. And maybe Anthony, what are you thinking about iCapital's portfolios? What are you allocating there right now?
Yeah. So, from our perspective, we sort of start thinking about it through the lens of outcomes. If you're an end client, are you looking for growth? Are you looking for income? Are you looking, maybe for a balanced approach? Are you looking for diversification, et cetera? So we sort of start with our approach there where we think about models from that sort of outcome-oriented perspective. Now, okay, let's say you kind of pick one of those verticals. Well, our sort of next step is how are you going to kind of express those views? Well, number one, you probably need sort of top tier managers. So we have a research team who, day in and day out are diligencing managers, looking for that, sort of upper crust. We're looking for that, top kind of quintile manager across, all these asset classes. So what we'll actually do is, we'll curate that set of managers and we'll continue to monitor them, over time. And then really what we do is we take a very intentional approach to kind of blending and creating these alts model portfolios that are easily implementable. I kind of think about this as an easy button for an advisor. So we'll work, we have our own, we'll work in conjunction with home offices as we've done with your team, Christo. And we will create these, I'll kind of call them optimized clusters of funds that are designed to meet a particular objective. So our growth model will pull in different private equity strategies across, venture, buyout, et cetera. Our private credit model will actually do some of what I was talking about earlier. We'll look across, upper, middle, lower market and kind of create a diversified portfolio. Our balanced model will take into account, real estate as well alongside private equity, private credit. And really what that enables is, you're taking, the intellectual capital of, iCapital with one of the biggest, research teams in the space. You're combining that in many instances with the intellectual capital of the CIO or home office arms from various wealth managers, and we're kind of building these these sleeves that an advisor can very easily implement in a portfolio. Through our technology, you're able to basically say, hey, let me take that growth model, I'll drop that into my 60/40 portfolio, maybe I'll allocate that away, pro rata for my equity sleeve. With a single click, you can, kick off a multi-subscription workflow, although we're working on making that, kind of a little bit smoother. And then you're sort of off to the races from that perspective. So really, what we're trying to do is reduce the amount of complexity that advisors have to deal with as they think about portfolio construction, and help them focus more on, let me take that outcome and let me talk to my client and let me build the right outcome for my client.
Thanks, Anthony. And Karen, what are you finding out interesting nowadays?
Oh, yes, I'm with Brian. Asset-backed finance. And one thing that I would love to share about why I'm excited about this is that what I think it does for us is gives us direct access to the economics. We cut out sort of the middle, organization in being delivered structures of, collections of loans. And so whether that's in non-residential, non-agency securities, if it's in, airplane finance, if that's in, there's so many different, I think there's 34 trillion here, but I can't come up with 5. Anyway, it's a huge potential for us, giant asset class. And so, you can buy a piece of structured product, asset-backed security in the public market. It's going to come through our public market fixed income manager, or I can go right to JP Morgan now, and they'll share, the goods that they've been producing in their investment bank directly with their asset manager organizations, and I can get direct. So, that's one iteration in the market. The other, there are many different models in which this is coming to the market, and it's super exciting. It is a lowering effectively of access to this particular class. It's, for us as an insurance company, it's a great fit. It's property and casualty insurance, meaning the duration of our liabilities is short. So it's these tend to be shorter duration loans. They tend to be high quality, investment grade. They're private. Now, I will say that the spread relative to publics has come down about 100 basis points in a year because now everybody's found it. So rush out and get it today. But I do think, we have everything else. This is one area that and the way that I think about investing more generally is every universe of securities we should try to be in, unless there's some barrier to entry or some expensive, limiting factor for us operationally. We're going to be in that, and so this is a big one for us.
Thank you. So a solid vote for asset-backed finance, and maybe to take everybody's opinion on that, but asset-backed finance is basically a part of everyday lives. It's the plane you flew into, if you flew in from somewhere, car people drive, houses and apartments that people live in, and everything else in between.
The worst thing I ever learned from our asset-based finance team, this is our aviation leasing team, that they buy airplanes and lease them out, is that there's a little sticker that tells you the age of the airplane when you walk in there. It's really not supposed to go more than 30 years. The one I flew here was 29. I almost asked them if that was okay, but I wish they never told me that, because now I look at it every time. But now you've been cursed with that same knowledge as well.
Where's the sticker?
Right when you walk in on the door, there's a little metal stamp on the inside of the door that tells you. But you get into new markets, you learn new things, and asset-based finance has been great in a lot of ways. But that's
at
one
least
way.
It wasn't solar.
Yeah, there you go. It's not a solar-powered airplane. Yes.
So it seems like we transitioned into the question and answer session. So maybe we can ask a couple of questions.
That's actually a good point. So I will tell you, not to get too into the weeds, but in our aviation strategy, we buy, midlife, narrow body 5-year airplanes because they're in demand. The technology's been tested. They're not too old. So we actually play in that market for that specific reason. Yes, agreed.
In the context of asset-based finance, let's say infrastructure projects, do you usually have, taking for example the Brightline project, which is the private railway project that's supposed to be built from Los Angeles to Vegas, and we have another one in Florida. But the question is, Do you usually have like subject matter experts in those particular fields to be able to analyze and forecast them?
Absolutely. So for us in particular, we're focused on energy transition and aviation. Those are two big areas for us. We absolutely have the expertise both in staff and then also the folks that we partner with would be developers of these projects. But in the case of aviation, we own a 70-person aviation leasing business, and all they do is buy airplanes, service them, and lease them out, and we have our own engineers. So you absolutely need the technical expertise, and then even the portfolio managers that are managing our clean energy strategy have engineering backgrounds. And so absolutely you need that level of expertise so that you can speak the language and properly underwrite the deals.
Which, by the way, is why another reason why I like that this world of lending has come into asset management, because the resources applied, the engineering, better quality underwriting, the monitoring, the creativity around the contracting that, we have as a part of our programs, you can't typically get that in a bank. And so I fully expect that this market will continue to evolve greatly over the next 5 years.
Thank you.
Thank you. As you're thinking about asset-backed finance, how do you make sure as an investor that you're getting compensated adequately for complexity risk, and how are you thinking about the underwriting risk in these structures? Karen talked a little bit about how the spreads have gone down, so just wondering how you think about that. Thank you.
Yeah, I'd say that. I think it's gotten more competitive, but there's still plenty of pockets of the market where we have specialty lenders that need to be underwritten, and they don't really have partners that can do that, in as much of the capital that they need. So there's still plenty of areas where you're being well compensated. I think part of it as an asset-based finance manager is, when we evaluate the deals, we don't want to just underwrite the asset and the borrowers. We want to underwrite the platform, because at the end of the day, you're partnering with a non-bank platform in many cases that is originating this debt. And you want to make sure to underwrite that platform itself, look at loan level data going back to history to make sure that they are actually good at underwriting. But another thing you can do to protect yourself as an investor, and something that we do, is we actually will hold back a large portion of their servicing fee, this is how they get paid, until we reach our target IRR, meaning a priori before the fact. We know what the interest rate is, so we know if there's no defaults and the world stays the same, we know what our spread is, we know we're getting compensated. But like all credit, there's a loss rate, there's a recovery. Usually you have an asset behind it, so that helps the recovery. But at the end of the day, that initial yield and the loss rate is part of the things you agree on, or at least we agree on with these partners. And what we'll do is, again, we'll hold back their servicing fee until we hit that. And if we don't actually get that, they have the first loss, so they remain subordinated. So that gives us a little padding. It incentivizes them to underwrite properly and collect on assets when they have to. But at the end of the day, like any other investment, there is risk. There's a lot of opacity. These are very complex structures. And I think over time you find that you make mistakes, and that's how you learn from them. And I know our team talked about years ago where they actually got data from an underwriter, and the data turned out to be bad data. Now, we had legal recourse, right? But you do have to be careful in private markets about things like that, because there's a lot of opacity.
So, Brian, you mentioned assuming no arbitrage, and whatever risk is not being reflected, you add it to the tail risk. And it might be a question for Karen too. So when you're modeling that, let's say I'm used to an MVO traditional optimization model. Do you use, what do you use for tail risk? Do you use like a CVAR or some other?
Yeah, so really, we're allowing the model itself to evolve. So we build it into the distribution. So you think about every asset class is built up from these building blocks, and ultimately you have a distribution that is then run through the model. And so you can think about the distribution as actually adding fatter tails to that distribution. And the way that we ultimately, it materializes is when you run the Monte Carlo, you then test the tail events. And what you usually find when you add these private markets, because volatility is low, and because of the way they behave with the premium, you don't see that in things like a probability of a 20% loss, which a lot of people think about as the tail event. But you do see it in a 95, CVAR or 99 level. Either way, you'll see a higher loss with alts added. Although I will say, and I think this is to Karen's point earlier, is that if you add certain alts with each other, like a tail risk hedge fund, certain alts in combination can actually act in a way to mitigate those tail risks. So I think, that gets back to the diversification within alts, and I'm sure, Karen has.
Yeah, I love your question because part of the fun work that we do is we get to play around with our tools and evolve our tools. And one of the ways in which early days I wanted to make a provision for is a realistic description of tail events. And so, yeah, you could figure out, oh, well, that's a different distribution. It's not a normal distribution, but there is another way of doing it. If you have a framework of common factors, and you can estimate the first and second moment, the mean and the variance effectively of those factors, using data going back a very long time, and then you ask the question, well, gosh, if I sort of separated this series of returns into sort of normal states and bad states, could I construct the same mean and variance and then blend those two things together? And how you blend those two things, the probability of this drawing from this normal state or this relatively good state and drawing from this bad state, gives you this very interesting, wow, that looks like reality tail distribution. And from there, you can ask the question, which is a little bit like a scenario analysis, if I add this particular strategy or tail hedge to the portfolio, what kind of effectiveness does this give me? And it, typically a tail hedge, actually, people don't get to see this, pays for itself because things happen, bad things happen, and drawdowns happen more often than we would predict, that normal distribution would predict. So anyway, that's some fun stuff that I like to do, and it's actually a very simple framework in a sense. It's called a regime shifting log normal model, and for those of you in the room who are quants and are curious about how I do it.
There's a question on that side of the room.
With all this great diversification potential, factor exposure, risk premium, at the portfolio investment level, how does the cost and fees of these kinds of portfolios and investments affect the difference between gross and net return?
Yeah.
And what kind of haircut can one expect when they're making the investment in these things?
So I don't know how you all do it, but let me back up a little bit. I actually include planning data before I run anything. So I'm going to ask the question, what is it that you're shooting for over what time horizon? How much drawdown can you really tolerate? And what is your sort of, I can't go, this is a third rail. So I'll give you a few no, I don't want to go below 10% over this time horizon, but I can't go below 20, no matter what the loss is. It's just a drawdown number. It's not even a loss number, but just a drawdown number. And that can be motivated just by risk preferences. But of course, you're going to think about along the way, what am I paying for this program? And of course, you're taking the cost out of this program on a systematic basis. So you can actually build that right into your model and know what the cost of carrying this program really is to you. And I think that's a super important tool as well, because of course we're being sold products all the time with all different kinds of exposures, and some of them are super expensive. So anyway, the bottom line is you can do that. It's imperfect with private equity or where you have certain conditional payment structures, but I find that it gives you a good sense, a directionality, and is this going to be helpful or hurtful to the portfolio?
Yeah, I would just add to that when we're modeling this stuff, we're modeling it on a net basis. So we are absolutely including fees because, to your point, I mean, fees can really eat into, and I'm sure you see this doing manager due diligence all the time. It sounds great. These are very expensive programs to run, but, the fees, even if they're justified, can sometimes eat into it. So we would say modeling it, with fees included.
Yeah, I'd say just from our perspective, a couple of things. When we model, just like my colleagues here, net of fees, of course. But the other piece of it is we think about, giving, our users on our platform the ability to actually do diligence on funds. We we have, I would say one of, if not the largest, one of the largest, compendiums of currently offered and previously offered private funds, in the world. We offer a kind of an apples to apples fee comparison that allows advisors to, in their selection process, understand the relative fees of different products.
And we have to at least let her have the last question.
In regards to the factor models that you discussed, I'm assuming that they're weighted, and from a perspective view and a macroeconomic perspective, do you see those weightings shifting in the next, I don't know, however many years you can discuss? And also in regards to asset-backed financing, do you see an oversized or oversized investments towards a particular type of asset?
You want to take the factor one?
So weighting, I'm going to guess that what you mean is in terms of risk, or weighting in terms of
correlation.
correlation? So, look, there are probably really fancy ways of weighting and, making sure that you've got all the factors that matter to the investment process that you run. And what I would say is that I work with macroeconomic factors that are long-lived. And so I'm going to focus on and not differentially weight in an investment portfolio the factors which drive those returns. In other words, it's a straightforward exercise to say, okay, these are the returns from this strategy. How did they load on these factors? And use those weightings as a basis for projecting future outcomes. Now, you could say, well, that manager looks like, 0.5 beta this year, and next year is going to look like a 0.6. To my mind, that's a scenario analysis kind of investigation. Well, can I tolerate a manager that's going to have a 0.6, if that's what you mean, a 0.6 or a 0.7 or a 0.8? Anyway, that to my mind is a tool that, that you can apply to answer that question.
And just to quickly answer your second question in terms of kind of the areas we're most excited about in asset-based finance, I would say consumer in the U.S. is very interesting to us, aviation, energy transition. Clearly, we need a lot more energy infrastructure build out. And a really interesting one is housing in Europe. There's a massive undersupply of housing across Europe. They don't have small banks or regional banks, and there's really no supply of capital for smaller developers. And so we're finding that to be a very, very fruitful place to invest is housing in Europe.
Thank you. I think we have about maybe less than a minute left. So maybe we would, unless there's any super pressing questions, we can say thank you to our panelists for a great job today and appreciate you guys stopping by.
Thank you.